Well, the last public conversation that Treasurer Jim Chalmers launched was about superannuation and tax. Well, in that case, there was a little less conversation, a lot more action. A new tax on super funds with more than $3 million in them was created within a week. So with that lesson, when Chalmers yesterday called for a conversation about capital gains tax, I'll tell you, you want to listen up or speak up pretty quickly. Daniel Kave is the partner and the head of tax at Thornton in Melbourne and joins me now. Daniel, many thanks for your time. Look, I mean, you've got to be at least aware of what the Treasurer is doing here, because there have been calls for a reform of capital gains tax for a long time, haven't there?
There have been, but it has been put on the back burner. But as you know, Ross, the government's heavily focused on balancing the books. I mean, the reality is over the last few years, government expenditure across a number of governments has really outpaced economic growth and the related tax base. So they need to do something about it. And this is one area that they're looking to potentially target.
So in that regards, Daniel, there's also this situation that quite clearly capital gains tax now generates, I'm just having a look in the budget last year, $21.9 billion they're projecting out of a $601 billion budget. Now you compare that with, GST is $82 billion, company tax $127 billion, and individual taxes are $260 billion. It's not as though it's a massive revenue earner for the government. So where are they talking about getting $5 billion out of these capital gains tax breaks from?
Yeah, so the CGT discount, which was introduced, Ross, back in 1999, it's been a basic tenet of our tax system and our capital gains tax regime. They believe that Treasury have estimated it costs or contributes about $10 billion, the actual discount. So where I'm estimating the $5 billion comes from is if they can reduce the discount from, say, 50%, which is what applies to individuals at the moment, to 25%, all of a sudden that could potentially create $5 billion of revenue per year, which would have some sort of impact. Whether it's the right thing to do, that's a different question.
All right, so then you come to people who have got long-term capital assets now who might need to make a decision. Is this the sort of thing where you would then be prompted to take action ahead of any potential change by the government, or is it a case where you're going to sit back and just cop it?
Well, we've got to wait and see. There's a number of ways in which you can bring such change, the CGT regime. They could incrementally reduce the discount, so say to 40 to 30 to 25%. They could remove it holus bolus. They could grandfather it. They could bring back indexation, which was a system that existed pre-1999. But you're right, Ross. Every action has a reaction, and we have to understand that if they look to tinker with the CGT discount, as I said, which has been a fundamental, tenet of the capital gains tax regime, there will be a reaction. And in the context of where we sit at the moment economically, with interest rates rising, the last thing that we would want is to have even more downward pressure on asset prices. And you could imagine if all of a sudden you're saying that, pick a date, 1 July 2024, the CGT discount will be removed. Well, there'll be a lot of investors who are saying, well, maybe it's time for me to realise that investment. And the ongoing impacts that could have on asset prices need to be factored in.
Because I'm sitting here even thinking about a small business, a family business or something like that might be considering a sale down the track. There might be retirement plans. It might be because the family's getting larger, you need to break it up. It might be that you've just got a reasonable offer right now. And if you have a thought that maybe the capital gains tax depreciation, if you like, the allowance of 50% is going to be in some ways watered down, you're significantly better off if you can do that deal now rather than waiting until July 1 or waiting until you see what the Treasury is going to do.
Absolutely. So it may have an impact in the short term and may force prices down. In the long term, it'll have an impact as well because it'll encourage investors to hold on to assets longer or to restructure assets and investments. So, look, I think this is, a small targeted piece of potential reform. My view would be that we need to have a look at wider comprehensive tax reform. There's no doubt that, Australia is craving that. It's craving that for simplicity and craving that for certainty. We go back, a few years, for the Henry tax review where Professor Henry put forward 138 recommendations for tax reform and only 3 have been implemented. I think we need to have a far more far-reaching conversation rather than picking 1 or 2 easy targets.
Okay, so just let's go back and analyse again that 50% discount that now is applied to capital gains. If that's changed, how does that change the nature and the way people will hold on to assets in the future? As distinct from, given the fact that the other option is you can actually allow your gain to be discounted by inflation, which, okay, right now is running hot, but otherwise is suggested to average 2.5% over the long term.
Yeah, look, that's right. And, technically what it would do is it'd be a disincentive to transact because you're better off holding rather than investing into a new asset. Remember, there is a 12-month requirement that you hold onto these assets for 12 months in order to access this discount. But going forward, it may, encourage investors to hold on to assets for longer rather than triggering tax at top marginal rates. At the moment, the top marginal rate is 47%, so the maximum capital gains tax rate would be 23.5%. But you can imagine if that rate increases overnight to 47%, that would have a far-reaching impact. Now, the devil will be in the detail. As I said, there are different ways the government can go about introducing such reform. It can be incremental. It can grandfather certain, asset increases. So we'll have to have a look at what they're proposing. But, there will be reactions to this reform.
Be warned, I think, is the message. Daniel Kave from Grant Thornton. Always good to have you on the program, and many thanks for your time today.